Hello, everyone. Welcome to the first edition of 2021 of the Kallanish webinar series. Thank you for joining us from wherever you are in the world. Today we will be looking at the raw materials markets, namely scrap and iron ore, the latest developments and how they've impacted global steel pricing. Now, this time last year, the majority of us had absolutely no idea what was going to be in store for the remainder of 2020. It was a very, very challenging year, dominated, of course, by the coronavirus pandemic, which affected not just the steel sector, but all economic sectors around the world. It's likely that the pandemic is still going to play a very big role in 2021. It's not going to go away anytime soon. In order to make informed business decisions and have an idea of where the market is going this year, we will do our best to give you a good, insightful look into the raw materials markets globally. So I would like to introduce our two speakers for today's webinar. We have the managing editor Asia at Kallanish, Tomas Gutierrez, who will be talking about iron ore markets mainly, with a focus on China, which is his speciality, and of course about the big development of China beginning or resuming to import scrap after many years, and how this is going to affect not just the scrap market in China, but of course it's going to have send ripples throughout the global steel industry as well. Then following Tom, we will have Burcak Alpman, who's our Turkey steel reporter, our expert on the Turkish scrap market. She will be discussing this and bringing in some information about scrap in other regions as well. And the two things will tie in nicely, considering China is going to have a big impact on probably Turkish import scrap prices as well this year. So without further ado, I would like to give the floor to my colleague Tom Gutierrez, who will talk to us about iron ore and China. Tom, take it away, please.
Thanks, Adam. I'm going to focus my presentation mainly on iron ore. Burcak afterwards will be talking about scrap, and I'll be bringing in a bit more of my understanding of what's going on with Chinese scrap imports afterwards in the Q&A. But to kick things off, I think we'll take a quick look at iron ore prices. Now, obviously, since we last spoke on these webinars, prices have moved very, very dramatically. So there's been a surge through December, topping out, and then a wavering fluctuation since then. The surge has really been caused partly by the decline of port stocks in China, but also a surprisingly strong steel market for the winter in China, which we'll look at a little later, and also very strong expectations for 2021, both in China in terms of steel production and globally in terms of steel production and demand as well. And we'll look at those in a little bit more depth in the following slides. But I'd like to kick off with a poll. So Adam, if you could bring up the first poll.
Absolutely. So the first poll, everybody please do vote. We were very keen to hear your views on this. The question is, where do you expect 62% Fe iron ore prices to be by mid-February?
Thanks, Adam. It looks as though you expect a slight decline from current levels, but not a very significant decline. There's a clear lead for 160 to $170, 42%. Probably 39% of people think prices will increase overall, with 10% thinking more than $180. But 62% thinking prices will fall, including 42% a slight fall, and 20% expecting a more dramatic fall. it's always interesting to see people's views on this, particularly at the moment when there is an element of uncertainty around prices. Sentiment within China has fluctuated fairly significantly in the last couple of weeks. Overseas, it seems markets, in particular steel markets in Europe and the US, are extremely tight, and that has really driven bullish sentiment. But China, there's a different fundamental stage in terms of the development of its demand, which we'll look at later. But on top of that, there's also an element of risk to what's going on in China. So we can't really go through this without addressing one of the big unknowns for the next 2 weeks or so in China. There has been a return in coronavirus cases. Obviously, that's nothing like the scale that we are seeing in Western Europe or the USA or much of the rest of the world. But there was a significant impact on prices and on market sentiment as soon as new COVID cases returned to levels which had not been seen since the previous spike in the summer last year. This spread has been centered around Hebei, which means that there is a particular impact or potential impact on iron ore and steel making. At the moment, really the restrictions have been fairly light, but there have been restrictions in terms of logistics, particularly in terms of moving raw materials around the province. In the last day or so, it's been found that the virus has spread into Beijing, which means there's more restrictions expected. It's also spread into a couple of other provinces. So the numbers are actually still quite low in terms of what we're used to seeing in much of the rest of the world. But nevertheless, it's being taken, of course, very seriously, and there's potential for further restrictions. Now, what those further restrictions will be is pure speculation. So I don't want to say too much about that, but there is, of course, the Chinese New Year holiday approaching, and a very large-scale movement of people is obviously something that China would not want unless it's more confident that it has this virus under control. The center of the outbreak, Shijiazhuang in Hebei, is having another complete testing of its citizens, and those results are now beginning to be released. And depending on how much control Beijing feels it has over this virus, the measures in response to that are expected to be announced fairly shortly in order to have policies in place for the holiday. So there is a possibility of a threat. At the moment, the risk of that is there's very little risk of returning to the situation we saw at the start of last year with such a strict lockdown. But some restrictions are a possibility, and that's obviously impacting market sentiment. However, fundamentals are actually quite firm for China in terms of the steel market. So in particular for finished steel, but also for port stocks, inventory levels fell through much of the second half of last year, and in particular in December saw a very strong decline considering the historic levels of demand during the winter. End user demand was actually quite strong, and inventories have now fallen to levels which are really quite tight. And so that's been fueling a lot of this optimistic sentiment about the market in the coming months. Obviously, China has a very strong seasonal element to its steel demand. Normally, very strong demand returns after the Chinese New Year holiday. End of Q1, Q2 is normally very strong. And if the market goes into that with low inventories, then of course, steel mills are going to be confident in maximizing their production, and that means they're going to be buying iron ore. So that's a fairly strong background for the iron ore market, and that's been a key part of driving prices so high in the last month or so. So in terms of 2021 overall, these are our forecasts from the China Steel Intelligence, which we publish monthly. The key takeaways from this are that we actually expect end user demand to decline very slightly in 2021 compared to 2020. I'll say more about why that is in a moment. But we expect crude steel output to increase again by another 2.9%. So we expect steel production and blast furnace activity to remain fairly high through this year. And that, of course, is a strong support for iron ore prices, also for scrap prices, as we will look at later. But for the moment, focusing on iron ore, it means blast furnaces will be purchasing high levels of iron ore through much of the year. I want to say a little bit about why we've forecast that. It's quite important, obviously, when you're looking at iron ore markets and from now on scrap markets, to understand why China is changing. The key thing is that 2020 was, to a certain extent, an aberration, obviously because of the virus, but also because for the Chinese government, it forced a change in policy. So it moved away from its long-term goals, which are restructuring and controlling financial risk, and moving towards greater domestic consumption. And the focus was very much on stimulus and supporting the economy last year. That is changing. So the question is, how fast will that change? To say something about how important it is that it does change, the latest IMF Article 4 report noted it believes that the general government deficit was 18.2% in 2020, and that is obviously a very significant increase. That was up from 12.6% in 2019, not 2.6%. I've noticed a slight error in my slides, but nevertheless, it's a very significant increase, and it's unsustainable. So that has to change, and that will mean less focus on government spending, less focus on investment. It will mean more tax cuts to boost consumption. But the trend is very clearly in favor of consumption and away from investment. And in terms of steel demand, that will also create a change which China has been aiming to drive for a long time, but which it has not yet succeeded in making that change. And that is, if you look on the graph on the right, on the left, sorry, that the share of steel demand from consumer demand, so white goods, automotive, could increase in 2021. We expect it to increase slightly, whereas the share of demand generated by real estate and infrastructure will decline slightly. And that is the first time that has happened for many years. So that's behind the slightly lower demand forecast. Outside of China, of course, we're also seeing changes, and that is really driven by the prospect of vaccines, the prospect of an easier situation with coronavirus, but also the prospect of a return to focusing on just the economy. So there's a lot of stimulus coming, Southeast Asia, Europe, USA, everywhere there is stimulus. There's obviously the impact of the Democrats in the USA now controlling the House and the Senate, which allows for potentially greater stimulus there. So outside of China, there's a fairly strong economic environment that should support production. And we've already seen a recovery in production here from World Steel data. You can see the clearest increases so far being Asia outside of China. So, in particular, Japan has been bringing up its blast furnaces again. Korea has also been producing more, but also you see increases in North America, in European Union, in South America. Almost all economies are seeing sequential increases in production, and that will also be supporting iron ore. So finally, I just want to quickly note the implications of all of this for iron ore. the key thing for this year is iron ore demand is going to be high. Chinese iron ore demand will be high. Demand outside of iron ore will increase more rapidly than within China, but both inside and outside of China, demand should be strong. Steel prices will mean pressure on iron ore. So whereas last year China was supporting global steel prices by importing steel, that will not happen in 2021. We expect China to be a cap on global steel prices, and China will be returning to exports. And so that will push prices down, and that will also have an impact on iron ore. And we do expect iron ore prices to fall, even though demand is strong throughout this year. And that's also partly due to the supply side. Fewer supply disruptions in 2021 than 2020, as far as we know, barring any new dramatic news. That balance should allow prices to decline from current levels. But that doesn't mean expectations have returned to where they are before. So, if we looked 6 months ago, people were talking about $55 a ton iron ore. We're not going back to that just yet. Maybe in a few years' time, but not right now. That's partly because demand is actually surprisingly strong. It's partly because of the slightly weaker US dollar, for example, and a few other factors as well. So the trend is for prices to fall, but bear in mind that prices will remain volatile. There is still coronavirus around, which will probably throw up surprises. There's still volatility in politics in the US and elsewhere, and there's a lot of things that could push prices up and down throughout the year. So we expect more volatility again this year. I'm going to leave it there, and we'll talk more about scrap a little bit later. Thanks, Adam. Over to you.
Thank you very much, Tom, for that extremely insightful presentation on the iron ore market and China. I'm sure a lot of people will be quivering to hear the prospect of China coming back to the export market, but it's unlikely to be like it was in 2014-15, I guess, when Chinese material flooded the global market, especially if prices remain high. But that's maybe a conversation best saved for another time. So from iron ore to scrap, I would like to bring in my colleague Burcak Alpman now, who will give us an overview of the Turkish scrap market. Please take it away, Burcak.
Thank you, Adam. Good afternoon from Istanbul, ladies and gentlemen. I want to start my presentation with some brief statistics from Turkish steel industry before going into details. Starting with some major statistics, Turkey ranked 8th largest producer in the world in January-November period. As a result of the contraction caused by the pandemic, specifically in the first half of the year, among the 10 largest producers, only China, Turkey, and Vietnam have recorded an increase in crude steel production, while the others recorded a decline during the same period. In the first half of the year, scrap consumption has decreased in all major countries, including Turkey, due to the fall in steel production. As you may recall, among top 10 producers, only China and Iran have recorded an increase in crude steel production in the first half of 2020. Despite the fall in scrap consumption, China was the largest scrap consumer with 93.7 million tons, while Turkey ranked 6th with 13.6 million tons in the first half of the year. Turkey produced 33.3 million tons of crude steel in the 11 months of 2020. 22.2 million of the total production came from electric arc furnaces, and 10 million tons were out of blast furnaces. Electric arc furnace-based steel production's share among the total is 68.7% in Turkey. Turkey consumed 26.2 million tons of scrap in the 11 months of 2020, with 6.1 million from the domestic market and 20.1 million from imports. This was up 7.1% year-on-year. Although Turkey's scrap share among Turkey's total scrap consumption in the first quarter was 28%, it fell to 23% in January-November period. This was also a sharp fall compared with 32.6% last year. Being able to meet only 20 to 30% of its total scrap consumption from the domestic market, Turkey becomes the world's leading scrap importer. Turkey imported 20.1 million tons of steel scrap in the January-November period. During this period, Turkey's scrap imports increased 19.5% on year, despite the only 4.9% rise seen in crude steel production. Turkey sourced 63% of its steel imports from the EU, 20% from the US, and 11% from the CIS. On country basis, however, the US was the largest supplier with 3.97 million tons. It was followed by the Netherlands with 2.73 million tons and Russia with 2 million tons. The UK also supplied 2 million tons during January and November periods. This chart shows the price trend of Turkish imported scrap since 2020. It is based on daily price changes and represents Baltic and US origin HMS 80-20. As seen, after hitting bottom due to the pandemic in March, prices have recovered and even reached their highest levels since 2011 after November. We entered a very exceptional period starting from November, somewhat reminiscent of 2008. Scrap prices rose very sharply, as did the prices of finished steel and iron ore. So what happened in Turkey's scrap market in the last quarter of 2020? Due to the pandemic, serious drops have been experienced in steel production and consumption in Turkey and abroad, but specifically in countries such as the EU, the USA, Latin America, and India. In April and May, these drops have further deepened, while negatively affecting the production of iron ore and scrap. With the recovery started in steel consumption, specifically in the fourth quarter, the sentiment turned bullish in the global steel market. Steel consumption recovery, coupled with strong scrap demand versus tight supply, approaching holidays and winter conditions, strengthening euro, high freight rates, new lockdown announcements due to the second wave of the virus, caused scrap prices to start rising after mid-October. This bullish sentiment in the global scrap market strengthened sharply towards the end of 2020 on a mixture of rising finished steel prices, strong finished steel sales, positive vaccine news, iron ore prices which broke new records each day, the conclusion of the US presidential election, and expectations of a continuation of fiscal stimulus into early 2021. Finding further support with China's scrap import resumption and Russia's new export duty on scrap imports, scrap prices have made their strongest start to the new year, almost reaching 2011 levels. We have seen that shredded scrap has increased due to high pig iron prices. Coupled with the tight supply of shredded scrap, Turkish mills had to pay a premium for shredded scrap to replace costlier pig iron. The shredded premium, which was $5 under normal conditions, has increased up to $15 in some imported scrap bookings. Also, we have seen that some suppliers have been unable to collect the material that has already been sold due to the sharp increase also in dock prices. Specifically on the short sea market, we have seen that some suppliers have failed to carry out their contractual obligations and asked for delays or cancellations. Numerous exporters have suffered from this issue after the recent rapid price increases. Now we see that most suppliers are refraining from offering material before securing it in order to avoid losses. Business is turning like mostly to back-to-back. What happened, how was the situation with major steel products then? We have seen a significant recovery in demand for almost all steel products in early November. Steel consumption has bounced back at a faster pace than available supply. Not only has demand risen, but these gains have come at a time when inventory levels were historically low and needed rebuilding to support the rising demand. Available supplies, however, was far away from being sufficient to meet demand, and specifically in flat steel products. As a result of imbalance in supply and demand and rising raw material prices, steel prices have started increasing sharply. Rebar producers have managed to secure utilization until the end of February, while flat steel producers and wire rod producers filled their order books until the second quarter of 2021. Combined with various protection measures that have discouraged imports, steel supplies tightened to the point where some end users were willing to pay a big premium to secure desperately needed materials, raw materials, I mean. As a result, steel prices have hit their historical levels, even reached almost 2008 levels for some products. The supply continues to remain tight, leading to further increases, specifically in the EU and the USA. In Turkey, although domestic offers stand at 810, 820 ex-works levels for HRC this week, lower imported HRC offers are available, which exerts pressure on Turkish mills' prices. Despite the positive market outlook, this has raised concerns in the Turkish HRC market. On the rebar side, rebar prices have also started seeing resistance in both global and Turkish domestic markets. Current offers stand at $650 for rebars and $750 for wire rods. Considering the current level of scrap prices, we see that HRC and wire producers have much larger margins, but rebar producers are more squeezed between high scrap prices and low demand. This graph here shows the trend of HMS 80-20, of course, CFR Turkish scrap and Turkish rebar FOB prices since 2018. As Turkey is highly dependent on imported scrap and rebar prices follow similar trends most of the time, though the margin tightens or widens time to time. And this graph here refers to the scrap rebar margin. Between 2015 and January 2020, average margin between scrap and rebar appeared at $174.2, with high fluctuations, of course, as you can see on the graph. The red line here shows the average margin, which is $174.2, while the blue line refers to the average rebar production cost. We consider $160 as the average rebar production cost from scrap, with a very rough calculation, of course. Although the margin has hit $142 in January and in May last year, by the way, which is the lowest since March 2017, it has then recovered. Turkish mill scrap rebar margins have remained below the average cost many times until November this year due to the pandemic. However, scrap prices rose $188 and rebar rose $195 since the beginning of November. Current margin at $168 it falls below average margin but stays above average cost. For HRC, meanwhile, the margin appears at $330 today. So before sharing our outlook with you, we would like to see where you foresee the scrap prices by the end of January. Here comes a poll question.
Thank you very much, Burcak. So our next poll, please everybody do vote. We want to hear your opinion. Where do you see the CFR Turkish scrap price by the end of January? Will it be above $510 per ton, $480 to $510, between $450 and $480, between $420 and $450, or below $420?
Okay. I was really curious about the result of this poll, and I see that most of our attendees, 45% of our attendees, expect prices to rise further to 480 to 110 levels. Before getting into details with our outlook, I want to share some news that may affect Turkey's scrap market directly or indirectly in the near future. China allows scrap imports after a 2-year absence from the seaborne market. China's return has made sellers optimistic about the new addition to the global demand, while buyers highlight that the fact it will likely continue to push seaborne market prices to new highs. The Russian is to tax ferrous scrap imports at minimum 45 euros or 5%, whichever is higher, during a period of 180 days, by the way, starting January 30. The new duty is likely to put further upside pressure on Turkish import prices by potentially limiting scrap import sources for Turkish mills. Russia exported 2 million tons of scrap to Turkey in the 11 months of last year. The hike is aimed at securing sufficient and appropriately priced feedstock supply for Russian mills. Last week, provisional anti-dumping duties on imports of Turkish hot-rolled coil became effective in the European Union. As a result, duties of 4.8 to 7.6% will be now imposed to all HRC imports from Turkey, depending on the suppliers. As a result of provisional duties being applied, the registration process initiated in the fall of 2020 will be discontinued. A decision on whether to apply retroactive duties on the registered import volumes in 2020 will be taken when the definitive measures will be announced by July 2021. The Turkish companies that will be subject to anti-dumping tax made their objections on the subject. On the other hand, a counter step came from Turkey at the weekend. With the decision published in the official gazette on 9 January, Turkish Ministry of Commerce has announced that a dumping investigation has been initiated against alloyed or non-alloyed hot-rolled flat steel products, except for plates, of European origin and South Korea origin. Russian Federal Anti-Monopoly Services, FAST, suggested in late December that all exports of steel products should be liable for duties, not just ferrous scrap. FAST proposes export duties for steel billet at 13%, but not less than $73, and 12%, but not less than $78 for rebar. This is necessary in order to prevent possible reallocation of income from scrap procurement companies to steelmakers. This would be the case if a scrap export duty hike leads to a lowering of domestic scrap prices, while steel export prices continue to rise or stay at current levels. Turkey has signed a free trade agreement with the UK following Brexit. With the agreement, which is supposed to expand business relations in the steel industry, steel trade is expected to be balanced between two countries. Turkey's exports of steel products to the UK in the first 10 months of 2020 decreased by 64.5% to 101,000 tons, while imports increased by 41.8% to 334.2 thousand tons. Euro-dollar exchange rate, which has bottomed at 1.06 in mid-March, is recording a consistent increase since May 2020 and has even hit 123, which is highest since February 2018. This has prevented European suppliers from decreasing their prices on USD basis while increasing their costs. In January scrap trading, we have seen huge price increases both in the EU and the US. Shredded scrap price rose approximately 100 euros in the EU and $90 in the US from December trading prices. This was mostly the result of higher prices that the export destinations, also Turkey, have already paid during this period. Before going forward to our outlook, I want to share a slide with you showing Chinese scrap imports. China has been mainly scrap importer in the past 20 years and banned scrap imports as of 2019 until this year. In 2009, China imported 13.7 million tons of scrap. Top three suppliers for Chinese imports have been East Asia, mostly Japan, North America, West Coast of course, and CIS and Central Asia. So our outlook for semi-finished steel, semi and finished steel products. The supply and demand imbalance in flat steel products continues against the supply. Although production levels keep on increasing, the shortage is yet to be eased and expected to continue at least in the first quarter. As a result of tight supply, steel prices have gotten so high that imported material is now competitive, even with the tariffs in the US. Many buyers have begun seeking alternative sources outside the country to meet their steel needs. Besides, the new US President Biden said he would review Section 232 tariffs. Given its focus on American workers and restructuring, tariffs are somehow likely to remain in effect. But changes can be made to mitigate the negative impact on US sub-industries production, competitiveness, and to repair some core trade relations with other nations. However, US steel industry groups, associations have sent a letter to Joe Biden this week, urging his administration to keep in place the Section 232 tariffs and quotas imposed on steel imports. We will most probably see increased steel production as the tight supply needs to be eased. Some capacity additions have already been announced in the EU and the US. Similar announcements by other mills are expected to follow. Approximately 31 million ton of blast furnace capacity was idled in the EU during the pandemic. In the US, capacity utilization rates went down to 40% during the first wave of the pandemic and currently stands at 75%, which is still down from 8% last year. We are expecting to see higher capacity utilization rates to balance supply and demand. With the removal of scrap import ban, China is not anymore dependent on domestic scrap and is now able to expand its scrap resources. First bookings have already been concluded from Japan. Most probably, as we have experienced in 2009, Japan and US West Coast will be China's major scrap suppliers again. The Chinese steel industry's ongoing conversion towards scrap-based production or electric arc furnace production is likely to accelerate following the removal of scrap ban. All the Turkish HRC producers are more comfortable with their scrap HRC margins. Rebar producers are struggling to sell their products at current levels. Weak demand exerts pressure on rebar prices while putting rebar producers' margins at a risk. China's, Thomas has explained that this in brief, but China's steel output will increase in 2021, but demand is set to slow. That means China will not be supporting markets the way it did in 2020. China's imports will probably fall while exports will increase. However, currently demand is weak in China and prices are fluctuating. The demand is not expected to recover until the end of Chinese New Year holiday. But as current inventory levels are not high, China is expected to make a strong start after the New Year holiday. Coming to our outlook for scrap, winter conditions are expected to curb scrap supply for another while. On the other hand, rising production levels will increase the need for scrap. Scrap supply is expected to remain tight during the first quarter of 2021, at least until collection eases with better weather conditions. With rising costs due to higher export duties for scrap in Russia, the number of Russian origin scrap offers is expected to decline in Turkey. With approximately 2.2 million tons of scrap exports annually, Russia is one of the key suppliers for Turkey. The decline in Russian scrap is likely to have an impact on Turkish imported scrap supply. In 2009, when scrap imports were allowed, Chinese demand was strong and global demand was very weak. China imported 13.7 million tons of ferrous scrap in 2009, second only to Turkey. In 2020, strong Chinese demand and weak demand elsewhere led to China importing high volumes of everything other than scrap. Both these events took place when overseas steel demand declined dramatically while Chinese demand increased. 2021 is expected to see the reverse, like recovering global demand and plateauing demand in China. Another key difference is the balance of Chinese scrap markets. In 2009, Chinese domestic scrap generation was very low, but now China generates almost as much as it is likely to consume. As a result, Chinese scrap imports are not expected to return to 2009 levels. Scrap demand in the US and European domestic markets is expected to remain strong due to increasing production levels. And they are foreseen to continue until steel demand and supply finds the balance. As well as the export tax increase seen in Russia, Argentina has extended scrap export restrictions for another year as the international trade of scrap has increased significantly in recent years. Now with China's entrance in the seaborne scrap market, more countries may consider restricting scrap exports in order to secure the availability of the material for their domestic markets. Turkey has been the largest scrap importer for many years. Being dependent on imported scrap due to the low availability in the domestic market and high electric arc furnace production, Turkey, with more than doubled import volume compared to the closest competitor, which is India, was able to play the market maker role in the global scrap market. Back then, all Turkish electric arc furnace producers were producing long steel products. However, in the recent years, we have seen a conversion towards HRC production in the Turkish steel industry. As the market fundamentals and sales margins are completely different in HRC and Rebar's markets nowadays, a HRC producer can easily pay higher for scrap, but a Rebar producer may have to accept a loss. So there is an imbalanced situation between HRC producers and Rebar producers. Besides, China has now joined in the game and is likely to damage Turkey's role. Despite the price increases we are seeing in the European and US domestic markets nowadays, there is a significant increase in the number of deep-sea scrap offers in Turkey since the second half of last week. And it's from all regions, Baltic, the EU, the US. Turkish mills, which are trying to improve finished steel prices in a weak demand environment, have therefore backed off from the scrap market with the respite they have got for completing February shipment scrap bookings. Besides, the dollar strengthened against the euro, which could reduce upside pressure on dollar-denominated CFR Turkey prices in the short term. Although the global sentiment is still bullish, these developments in Turkey exert a pressure on scrap prices. US and Baltic suppliers are heard to have decreased their offer prices from $485 last week to 480 levels and even lower, but yet to see interest from Turkish buyers. Turkish mills price idea for scrap is way below these levels, not more than $470. Even some mills are heard bidding at $450 for imported scrap. As a result, we are expecting to see a correction in scrap prices in the near term in Turkey, maybe up to $30 during the slowdown in China. However, not a significant fall is expected due to the reasons we have covered in our presentation. Scrap prices in general are expected to remain firm, at least in the first quarter of this year. That was the end of my presentation. Thanks for listening.
Thank you very much. Very comprehensive look at the scrap market. We will be moving on to the Q&A session now. Say hello again to my colleague Tom, and we have a lot of questions to answer and a limited time to do so. So we'll quickly move ahead. Just before I ask the first question, I'd like to tell everybody that the presentations are available to download in the handout tab on the right-hand side of your screen in the control panel. So actually my first question was going to be about how you see scrap prices developing in the near future, Burcak, but you literally just answered that a second ago, so you preempted me there. So I'll go first to Tom. And since it's only been 2 weeks, obviously, since the 1st of Jan when China resumed importing scrap, but so it hasn't been a long time. But has there been how is the market digesting this so far? Have there been many scrap import bookings, and what does it look like for the rest of the month up until the Chinese New Year?
Yeah, it's been interesting because actually, no, there haven't been that many scrap bookings. So bookings are allowed. Burcak mentioned the two from Japan at the start of the year. These were kind of partly symbolic, partly as a signal. The first one was 1st of January, a subsidiary of Baowu Group came in. Baowu Group is a policy company, basically. It is centrally owned in China. So it's, essentially saying scrap can be imported, so don't shy away. But the problem is prices, right? I mean, globally, prices are very volatile. Scrap prices are very high. China currently doesn't have particularly strong demand. There's expectations of strong demand in the next, from the end of Q1. But it takes a very brave buyer to pay current scrap prices to import into China. And I think in the current environment, people aren't that brave yet. But this month will be quiet, but it will pick up later.
Okay, thank you for that. I know that China, a big part of China's policy has been to develop more of its own domestic scrap processing capacity. We have a question from one person. Has the policy in China or to increase shredded capacity, processing capacity, borne any fruit yet? How far has it advanced? And do you see this having a direct effect on decreasing shredded scrap imports, therefore, into China?
Yeah, so specifically on shredders, China overtook the USA as the country with the most shredding capacity about a year or a year and a half ago. And that availability of shredded has increased very rapidly. Of course, the Chinese market is huge, and so the proportion of shredded in the Chinese market is still low and can still develop. I think China probably will still be interested in importing shredded scrap, but really the level of import of any particular kind of scrap just depends on price. China can consume a lot more if the price is right, but it won't buy if the price is wrong.
Okay, and then like I said before, Burcak, it's still early days. The Chinese scrap imports have only just resumed. But what are your sources telling you? How do they see, and how do you see the resumption of Chinese scrap imports affecting scrap markets and scrap prices in Turkey and the US and Europe and the rest of the world?
We think we will see new normalization in prices. I mean, the prices with China's entrance in the seaborne market, the prices will come to higher levels. The normalized prices will come to higher levels in scrap. Because not only China, the US and European demand is also very high, and coupled with China's entrance and the restrictions, the increased duties in Russia, I think we will come to new higher normalized prices in scrap.
I see. Okay, and of course, if there's been talk also of the European Union considering restrictions on scrap exports potentially, which would again reduce supply on the global market of scrap.
Yeah, it can. There have been always talks about this, but it was never realized. But they may just, handle this issue again. And I think, like the Argentina, like Russia, we may see more. As I told during my presentation, we may see more restrictions for scrap exports to protect the domestic markets.
Yeah, we'll have to see how that one goes. Tom, you may have touched on this briefly in your presentation, but what impact will the resumption of Chinese scrap imports have on the iron ore market in China and iron ore prices, in the short term and long term?
Yeah, it's an interesting question. In the recent past, Chinese blast furnaces have been able to produce at very high levels, even when demand has fluctuated. And that's been because high domestic scrap prices have meant that EAFs would always shut down before blast furnace-based producers. So EAFs were always protected. Over time, as China's scrap market becomes increasingly supplied, both through imports and through higher domestic supply, blast furnaces will start to lose that protection. And so that will be a change going forward. But in terms of the balance, what we should see is that domestically, scrap prices should decline to a level where they're more competitive with iron ore prices. But outside of China also, we should see blast furnace prices and scrap prices more closely interlinked. And if that happens at a level with a higher scrap price compared to what we're used to now, that does create knock-on implications in terms of blast furnaces versus EAFs. How competitive are they in terms of their cost? There could be some problems for EAFs going forward.
And do we feel that that iron ore and scrap prices, which are both at multi-year highs, do we feel that they have peaked now, or is there? Do you think this is a question to both of you, Tom and Burcak? Is there room, do you think, for raw materials prices to increase further? And if they decline, I think Tom, you mentioned in your presentation that decline is ultimately expected at some point. When is this going to come about?
The decline in scrap prices in Turkey, talking about specifically in Turkey, I think they're about to start. I mean, a correction maybe, because the imbalance is now against the supply. There are more cargoes available in the market, but the mills are showing no interest. So I'm expecting to see a decline maybe this week, even this week, maybe starting from next week. We have mentioned the current prices at 480, but this was the level of latest bookings. So I'm not expecting to see more than 170 in the next deal. So I can say the decline in Turkish scrap has already started.
Yeah, I think in terms of China, the question is the expectations for after the holiday. From now until then, there will be fluctuations, but it's very difficult to see prices increasing further from general levels around $170 a ton. More likely there will be a decline because there's uncertainty around coronavirus and so on. Once demand does come back in terms of steel demand later in the year, then you could see iron ore prices pick up again, but it would be hard to go over the current level because that would imply mills purchasing iron ore at high prices for a period after peak demand, which doesn't make sense because their margins will not be as protected. So I think we are at the peak, with the caveat obviously that everybody got it wrong last year. So we'll see what actually happens.
Absolutely. Taking last year into account, it's impossible to make any sort of forecasts. Who knows what 2021 has in store for us? Hopefully it won't be as terrifying as last year. But staying on scrap in China, we have a question here about importing ships into China for shipbreaking, for recycling. Is this something which China does a lot of now, or will it increase now that its focus is turning to scrap? How do you see that?
That's a good question. So China was a fairly significant shipbreaker for many years. That market really kind of died off. It wasn't self-sustaining. But China does still have demand for scrap. Shipbreaking scrap in China is it's a premium scrap, so it does have a good price. There are moves to consolidate shipbreaking operations, and China does have some other advantages. For example, it does already have shipbreaking yards, quite high grade, high level shipbreaking yards. It's not a beach like they used to do, in Bangladesh, where you just drive it up on the beach. They have proper facilities to do it safely and to international standards. So I don't have a specific forecast on that, but I can see it being somewhere where there is opportunity. Yeah.
Okay, thanks. And Burcak, staying on that topic, how significant is shipbreaking scrap in Turkey in terms of how much does it contribute to the overall procurement requirements of Turkish mills scrap buying? Is it a big proportion or not really?
I think out of 10 million domestic consumption, last year, I mean, in 2020, 3 million came out of shipbreaking. Interestingly, we have seen an increase in shipbreaking scrap during pandemic because many cruises have come to shipbreaking in Turkey. So we have seen an increase in supply side, and Turkish shipbreaking associations have revised their output predictions for 2020 for higher output.
I see. Okay. And in terms of staying with you, Burcak, of course, rebar mills in Turkey have historically been the major buyers of imported scrap, and they move their business moves the global scrap market. So rebar is, of course, the demand for rebar is a significant factor to consider when looking at scrap purchases. How do you expect rebar prices to develop in the next few weeks and months?
Actually, I think rebar prices have also peaked because current levels at 650 do not find acceptance from buyers. I mean, the buyers are already very limited. We haven't seen significant sales in the recent weeks, in the last 3 weeks, let's say. We have only heard a booking to Hong Kong from a Turkish mill, but it is also said that it's a compensation of a previous sale at lower prices. I'm not sure of it, but the prices are seeing resistance from buyers both in the global market and the domestic market. So I think in line with the price declines in scrap, the rebar prices are likely to soften.
I see. Okay. And coming back to China, Tom, we have a question or a comment from one participant here, who says that a Chinese industry minister recently said that China must reduce steel production compared to 2020 this year. I don't know if that's accurate, but in any case, you said that China is going to increase steel production this year, whereas finished steel demand is likely to decline slightly. So the overall question, I guess, is why then is China increasing steel production regardless?
Yeah, sure. So this is actually a misinterpretation of comments which came out with being widely reported in English language media. It was from the Ministry of Industry and Information Technology. It was announcing it was a short announcement basically saying that from 2021, China should aim for year-on-year declines in crude steel production. And that had been taken to mean a year-on-year decline in 2021. But that is a broad policy goal in the framework of the 5-year plan. So that's 2021 to 2025. There should be year-on-year declines in crude steel production. And we think they will achieve that. In 2021 itself, however, we're starting the year with no new policies to control production, with higher capacity and with no lockdown. So we don't think it's realistic that a year-on-year decline will actually happen this year. Next year, I think, is likely to see a year-on-year decline. We should see peak production this year.
I see. Thank you. And this is a topic which has already been on the cards since before COVID came along, but I guess it's been maybe accelerated to an extent by the pandemic. What is the outlook for high-grade iron ore concentrate, given the sort of focus on environment and climate change, the increased focus over the last few years?
Yeah, I mean, there is a general trend, which is, firstly, environmental factors mean capacity growth is restricted. the fact that mills are still profitable means there is still an incentive to produce large volumes of iron ore, and producing large volumes of iron, of hot metal. So producing large volumes of hot metal with limited capacity implies using higher grade materials, basically. And so that is likely to continue. And not just in the short term, but we do now see capacity peaking. Capacity has grown again over the last year in terms of blast furnace capacity, but that is peaking and that is coming down. And policy is again moving into tighten rules on replacement projects and so on. And so that trend will continue. And so there's always going to be that pressure for mills to purchase high grade iron ore that will maximize their production with limited capacity.
I see. Okay, thanks, Tom. And we touched on this, I think, briefly already, but if we could just recap, China resuming scrap imports presumably is going to tighten scrap supply further in the market, because a lot of it is going to go to China to feed EAFs. Will this, what kind of effect will this have? Knock-on effect on costs for EAF mills in the rest of the world? I assume it will, by keeping supply tight, it will keep scrap prices elevated and keep the margins under pressure for mills outside of China, EAF mills. Do you guys have a view on that?
I agree with everything.
With you. Yeah.
I think maybe
is
that you have, for example, in Southeast Asia, where you have a lot of competition between new blast furnaces producing long products and EAFs producing long products. Part of the pressure is going to come from the scrap costs on EAF producers, but the other part is going to come from these large blast furnace-based producers, which are seeing iron ore costs slowly shrink. So there's going to be squeeze from both sides, I think, not only from the scrap side. I think EAF in some parts of the world will be struggling. Okay.
Thank you very much for that, guys. We do actually have a few more questions on various other topics, such as the Russian export duties, the European anti-dumping measures, various questions about safeguards and European capacity, blast furnace capacity outlooks. These questions I would say would be best put and best answered by our colleagues in the Kallanish editorial team, who are experts in these various fields. And we will strive to send out an email after this webinar to answer the remaining questions which haven't been answered yet today, so that nobody feels left out. So before we end, because we're running short on time now, I would just like to thank everyone firstly for being on the webinar, for taking part today of the first webinar of 2021. There's more to come from the Kallanish events team. We have the Global Steel Markets webinar coming up next week on the 20th of January, and this will be followed in March, on March the 10th, by our very first International Steel Scrap virtual conference, and then a month later in April by our annual Asia Steel Markets virtual conference. So we will cordially invite and encourage everybody to come and join us at those events and be part of them and contribute to them, and we look forward to seeing everybody there. Fantastic. And I'd like to thank both of our presenters. I'm sure you agree they both delivered very, very insightful presentations. Thank you for your time, guys. Thank you for putting the work in, and I hope it was appreciated by everyone. But without further ado, I'd like to say to everybody, take care, stay safe, and all the best, and see you at the next event very soon, hopefully.